Vancouver home prices have dropped 8 of the last 9 months in a row. And with our country being in a per capita recession for over 2 years, and now we've got tariffs in place, could home prices go anywhere but down in the immediate future? Well, Ryan and I, Vancouver realtors for 8 years who have sold close to $500 million in homes, we're going to share our insights into where we think this market is going and explain what back to back record setting months of new condo listings are going to do to that property type. The February 2025 real estate stats are in for Vancouver. Let's dive right in. Off the top, well, hard to not talk about tariffs because they're in, and I promise I will keep this short. To timestamp this episode, it is Wednesday, March the 5th at 1:49 p.m. I need to say that because, of course, by the time you watch this, tariffs could have doubled, been removed, been eliminated, been whatever. We don't know, but let's just go past that noise and just discuss a couple of key elements of what is happening with tariffs in or not. We did touch on this on 2 of our previous episodes, so check those out if you haven't. But we want to share some kind of initial data that's already been coming to the surface that could very well be an early insight into what's happening with tariff effects. So even the threat of tariffs have put buyers on the sidelines, right? This started about a month and a half ago with all of Trump's talk, and the immediate sales volumes impact are prevalent. We'll share the Vancouver numbers a little bit later in this episode, but check out Toronto, right? Toronto is largely considered to be the epicenter of both the condo collapse and that province and that city to be the hardest hit by the trade war. So after sales increased month over month by 12% in January, the tariff talks then began, and February saw a 28% drop in sales volumes month over month. And February, I mean, typically this is almost always higher in sales volumes than January because that's sort of the kickoff to the typical spring market. Side note here, oddly, the price of homes actually went up in February, like 0.4% month over month. Still, I don't know, almost down 2% from year over year. I think that's just an outlier, and we'll see prices continue their downward trend next month. I mean, it's going to be short-lived, kind of like what happened in Vancouver last month, right? Remember, the HPI ticked up for some reason, and then, well, this month you'll hear what happened. So when we look at that month, though, when we pull back, let's look at the 50,000-foot view. With how low sales were in Toronto last month, when we go back a quarter century, when we go back 25 years, there's only been 2 other months that were as bad or worse than last month. And that was April of 2020, when the world literally shut down and no one was thinking about buying a home. And December 2008, when the global financial crisis was essentially at its peak. And again, everyone was just frozen, almost like their bank accounts. So that just goes to show that last month was as bad as COVID shutdowns and GFC. That is terrifying. Okay, these are significantly low numbers. The spring market for real estate, at least in Toronto, it's all but disappeared. Now, quick shift into GDP here. Odd because, well, let's just dive into it. According to the numbers that be and those who report it, say that the Canadian economy actually expanded at a stronger than expected 2.6% in an annualized pace. That was essentially my response as well. In the fourth quarter, right? This is far exceeding the Bank of Canada's estimate at 1.8%. However, under the hood, details, well, they left a little bit more to be desired. According to StatsCan, GDP actually fell on a per capita basis again, which is how I think we should be really looking at this, dropped about 1.4% in 2024 as a whole, and it was down 1.3% or negative 1.3% in 2023, right? So you've got 2 years back-to-back negative GDP per capita. That means we have been in a recession for about 25-ish months now, maybe more, 27 months, long time. And I know it feels like it to me, right? That's the sentiment out there for sure. I believe that over the 2.6% positive over the last quarter, any day, right? Especially when like we talk about the very recent StatsCan report regarding job vacancies, right? They plunged much lower in December, and the job vacancy rate dipped to the lowest level since 2017. Okay, so we're at what, an 8-year low in job vacancies? You know, this is leaving workers ultimately in the worst job prospects environment that we've seen in 7-8 years. So yeah, like there's no jobs, but GDP soaring. I don't know. You believe who you want to, but that's what the somewhat opposing data is showing us.
Who to believe is right, Dan. I mean, it's possible that, maybe there's headline inflation that's raising the total growth of GDP. But ultimately, I mean, GDP should really be measured against the deficit that we have. So, if we're growing by 2.6%, who cares if we're going backwards in debt by 4%? Just a I don't know. I don't. None of this feels like it's happening on the ground. When we're on the ground and the things we're seeing, the people we're talking to, we are not seeing GDP growth. Certainly, behavior does not mimic the statistics. So, I'd love to see where this is all coming from, and it'd be really nice if everybody stopped playing with the numbers for once, just so we could tell which direction our country's going. Kind of like the 5-year bond market. If there is any positive news for homeowners in all of this, the Canadian 5-year bond yields, they continue to drop. That makes mortgage rates, certainly, people who are renewing their mortgage rates, the 50+% of borrowers renewing, over the next 2 years, this is welcome news. The 5-year bond yield was at 2.5% or 2.6% at the time of this recording. It's marking a 3-year low. That's a trend you want to see if you're renewing credit or you're renewing your debt load. Interestingly, it was also exactly 3 years ago that home prices were at their all-time highs. And I'm not saying there's any correlation here, but it's just an interesting data point that we discovered. But I think bond yields are also a very good indicator of the overall health of the economy. And so maybe I'll just add into some of Dan's points here with respect to the tariffs as well, because in the short run, now that tariffs are firmly in place, and with the threat of counter tariffs now looming as well, it's likely the BOC will be forced to respond by lowering rates much further than they had anticipated prior to all of this noise. This will likely happen because we will see our GDP actually decline despite what you might be told. And we can see that in the per capita GDP. So it's a matter of time before the overall GDP continues to follow. And it may drop at an alarming rate if we maintain 25% tariffs or if they get increased. This will be a huge drag on the economy and very likely result in the overall economy contracting, especially at a time when we hit an election season. So if the economy tailspins into a recession here, without really a clear way out, it will require structural changes to our economy. And don't expect an immediate bounce or recovery out of this like we saw during the COVID era. This is markedly different. Instead, I think it'll take some time. Higher prices will persist because of higher taxes, hence tariffs. And as a result, we will pay more for the same goods we're already getting for less. Over the long run, you can see prices rise as we pay more for imported goods, while services drop and output falls, and higher levels of unemployment. It's kind of a classic recession, maybe leading into some stagflation. The question I have, especially for the government, is what kinds of domestic policy changes are we going to see? Will they be helpful, or will they be like the ones we heard yesterday, where our provincial government here in BC just raised speculation tax by another percentage point for both foreign homeowners and domestic homeowners? We don't need more taxes right now. We just had a huge tax put on us. But it's never like a good government, will never let a crisis go to waste. So will the federal foreign buyers ban get lifted? Will we see the removal of GST on homes? Will our government provide tax breaks to its constituents because they're getting a bunch of revenue now from tariffs? I somehow doubt it. So Canada, to me right now, feels like a business on life support. It needs revenue quickly in order to survive. So we need to look at dropping restrictive barriers to get to that result. We need more clients. We need to be open for business. We don't need more money printing. That's a sugar rush that won't provide any sustenance for permanent recovery, but instead would pour gasoline on our fire.
Yeah, it'd also be nice to have a functioning government in power too. That would help.
One that's open. Yeah.
Yeah. Okay, digs aside, I want to touch quickly here on some interesting and very relevant and very current supply and demand economics. Right? They're at play, and it's really good insight into what, dare I say, should be happening a little bit closer to home. This is what happens when price problems can be alleviated when red tape is removed. Okay, so here's a little story about Austin, Texas. Because nowhere in the US of A right now are apartment rents, dropping faster than in Austin, Texas. They're down apparently 22% from their peak, which happened in August of 2023. That's a significant drop. And why and how? Well, here's what happened. Massive migration during the pandemic pushed rents sky high. Sound familiar, right? They had a similar environment that we do here. But here's where things are different. The city of Austin responded with pro-development policies, and developers did what they do best. They built because they were basically given the green light to do so. Over 50,000 new rental units hit the market between 2023 and 2024, shifting the balance of power away from landlords and ultimately and naturally bringing rental rates down. Simple supply and demand at work. But where this is truly surprising is the speed of this cycle. Rents, they jumped 25% in 2021 alone. And again, the city responded, and by 2023, new supply was already flooding the market. 2 years, less than 2 years. How? Well, builders in Austin typically go from buying land to delivering units in 2 years. That is pure development magic. I wouldn't mind seeing a bit of that in Vancouver. I mean, it can take 3 years plus just to get the rezoning, and they haven't even put a shovel in the ground. Austin's going A to Z in 2 years, 24 months. Okay. And that dramatically shifts the dynamics of power, and ultimately being able to react in as close to real time as possible allows you to control things like spikes in prices. And this is both true in rental and end user home. So, if you are frustrated in what you see happening locally, it's really a local problem, right? This is exact proof that you can address housing shortages, rental unit shortages in almost real time if the city gets out of its own way.
Make a really good point, Dan. I mean, and then you forego having to look at crazy interest rate spikes to fight these things that affect a much broader spectrum of the economy. Texas is not Texas, I guess Austin specifically is a great example of what good governance might look like, right? As opposed to bureaucratic governance that we see so much of here, not just in Vancouver, but across many parts of Canada. Unfortunately, I'm going to get into some Toronto condo data here, and the news isn't as good as it was in Austin. In Canada, we face the complete opposite ability to respond in real time. The condo market is a perfect example. The Toronto housing market, including pre-construction condos, hit a major turning point in the summer of 2022. That's when sentiment shifted, sales slowed, and prices started correcting. Today, we're now entering year 3 of this downturn. So how long will it last? Nobody can know for sure, but one of the best indicators is, new sales and completions. In 2023, nearly 30,000 condos were completed in the Greater Toronto Hamilton area, a high number historically, and 2025 is expected to see very similar numbers. But with new home sales plummeting, it's only a matter of time before completions start to decline as well. In fact, they have started to roll over. Looking ahead, analysts expect 2027 and 2028 to be relatively normal, whatever that means. But after that, the market faces a significant drop-off. By 2030, projected completions fall to almost nothing. In fact, just 411 units are scheduled to be completed in 2030. That's barely one condo project for an entire region. I personally think this completion cliff may hit even sooner, given that the 2027 year marks 5 years since the downturn actually began, allowing most presale projects to finish construction. And here's the big takeaway. This won't just affect buyers. a large portion of these completions are rental units. So a housing shortage is coming for renters as well.
Completion cliff. You might have heard it here first. That is the new term, okay? Historically, right, there was the mortgage deferral cliff. That was nothing. And then there's the mortgage renewal cliff, which we're at the very beginning of. We'll see. But now, and hopefully here first, you have now heard the completion cliff. That's different. And that's the other side, because that is a supply side issue. And it's an interesting thought or vision, Ryan, when you were talking about it. I was thinking about, imagine walking out and you're touring the city of Vancouver as a whole, and there was only one crane in the sky, that one building for a whole region. Could you imagine what that would look like? It'd be bizarre, but that's where it's headed today, right? Yes, lots can change in the next 6 years, but again, that's an interesting image to consider. Okay, let's get into it. It is time for the February 2025 GVRD real estate stats. As always, they are fascinating. It's almost discombobulated where this is going. You don't know where to look. It's like one of those inbred dogs where the eyes go all weird like this. It kind of feels like that's the market. Hopefully that didn't offend anybody. Anyway, let's get into it. Total sales. Okay, sales is that health of the market. How many homes are selling, right? We just talked about how slow Toronto is. Well, Vancouver, 1,850 homes sold in GVRD last month. That's about 12% lower from this time last year and like 29% below the 10-year average. We are still slow, okay? Where this gets interesting and where you want to pay the most attention to is that since October of last year, sales were higher than 2023 each month year over year, right? October, November, December, January, all higher than the year before for each subsequent month. There was an increase in momentum as well, right? Year over year. It was just going faster. And we kind of had, a sense of increasing consumer sentiment. Things were kind of trending up right up until January. And then all of a sudden, tariff talk and everything else that's going on hit. And February, then all of a sudden, sales 12% lower year over year. So it really is notable and shows that the market ultimately just slammed on the brakes last month. The level of uncertainty created by Trump and his tariff talks have put buyers really on the sidelines. And now with tariffs in place as of Wednesday, March the 5th at 2:06 p.m., I think the spring market is largely gone and we will not see the usual lift in sales volumes.
Yeah, I largely agree. I don't have anyone beating down doors and we have a number of listings across various markets at various different prices. And we're seeing, granted, things are still happening, but just the pace that which we've seen over, say, the last 5 years is just not there. It's simply not there. And that's due in large part, I think, to this uncertainty. Let's see new listings, because I think new listings is also a very good forward indicator of how people are thinking, and maybe they're trying to dispose of property that otherwise would drag on them if things get worse. So 5,066 new listings hit the market. That's an 11% increase year over year, 12% above the 10-year average. But this is where things can get actually a little bit more interesting. February listings were actually lower than January, something we haven't seen happen in the last 6 years. Though what is most notable is the fact that condo listings in February were the highest on record for that month. And this is following January, that also saw a record number of condos listed in that month. Why is this the case? Why are everyone dumping condos? Is it a result of, is this, second property, third property, investment condos, Airbnb condos, all this policy change that is basically forcing people out of condos? Or is it more to do with the fact that it's really not the property type that most Vancouverites are looking for? And much to Dan's point, they simply take too long to build in Vancouver. So they become irrelevant from the person when they actually bought the condo to the time they actually get it. If we're talking 4 to 6 years from the time something gets pre-sold to the time you move in, life is materially different at that point. I've got a seller right now who's in East Vancouver. They bought a home, I think it was about 4.5 years ago. It was slated to complete in 3 years. It was a year and a half late. And this is only a 4-story building, by the way. And on top of that, They had 2 babies in that time frame. So what are they supposed to do now? This property no longer meets their needs. And so the longer it takes to satisfy the demands in the marketplace, the more irrelevant the things we build become. We need speed. So for me, we don't really need a whole lot more condos at this point. We need more missing middle housing. And that is why we're seeing, things like single family and things like duplexes, townhomes perform better, much better than the condo market because they have a much higher degree of utility. What's more, and maybe this is just the last point, a huge number of purpose-built rentals are on their way. So the ability to create a cash flowing investment for yourself is just not there in this particular market. And the arrangement for, mom and pop investors is just not there anymore. It's been all but sucked out of the marketplace.
I think too, Ryan, like we are literally recording this in March, and 5 years ago was when rates dropped to zero. Well, in April, right? We're a month away from it. And that was the very beginning, ultimately, of what is now becoming that 5-year term renewal phase. And so there's a good chance that these condo owners that are investors have run the numbers, they've talked to their lender, and they're like, okay, well, when we renew in April, May, June, July, whatever it is moving forward, their payments are going up 30 odd %. And they're probably looking at their cash negative condo already going, okay, well, we were okay to eat $400 a month, $500 a month. But now that that's going to 7 or 8, not really worth it, I guess. Right. So they are getting ahead of what maybe they think could be a whole ton of condos hitting the market for people who just don't want to either be further cash negative or simply can't even afford those new payments. So there could be a serious flood of inventory coming in the upcoming months. And this might be the people who are getting ahead of the wave. So time will tell. But let's talk about how all those new listings affected the overall inventory picture, because high levels of inventory continue to be the story. Home sales currently listed for sale rose 32% from this time last year. We're sitting on about 12,350 homes right now. Big picture, we are 36% above the 10-year average. It's a lot of homes. Caveat though, it's a lot of homes that a lot of people don't want, unfortunately, and they're still not affordable, right? So like, yes, there's inventory, but you go out with your buyers on a tour and there's the odd home, of course, that's fantastic. But overall, they're not, again, lining up, like Ryan said, or knocking down doors to buy this extra inventory, right? So it's not the great ones that are hitting the market. It's sort of like, the ugly ones. The ugly ducklings are getting pushed out first, let's just say. But I digress. Inventory right now, it's at a 10-year high for the month of February. We have not seen this level of homes on the market in this month since 2015. The highest inventory ever, just again for reference, I love looking back at history and kind of seeing, where does it all stand historically, right? Are we hitting records or are we actually subpar? Well, the highest inventory ever for the month of Feb was in 2012, where it hit 14,875. So that's about 20% higher than we are today. So yes, we're high, but you go back 13 years and it was 20% higher.
All right, let's move over here to the sales to active ratio. Obviously, this tells us if we're in a buyer's market, balanced market, or a seller's market. And overall, we're sitting very comfortably in a buyer's market at 15%. This is up 1% month over month, so not a huge change. This is the 10th month that we've had in a balanced marketplace. If we break it down by asset class, looking at detached homes is sitting at 10%. That is a full-on buyer's market, though it is up 1% from the month prior to. 20% for townhomes, much like I talked about. They are the highest degree of utility in the areas that people can afford. This is what we need more of. They are up 1%. Sitting just inside of a seller's market. Now, again, you typically want to see 3 months in a row that create a trend line for this stuff before you will call it a seller's market or a buyer's market or a balanced one. Looking at condos, they're sitting at 17%, which is right there in the middle of a balanced marketplace, up 1% from the month before.
One area of divergence between Toronto and Vancouver is the foreclosure market, right? These court-ordered sales. We see a lot of headlines and a lot of stories about how high or how dramatically the increase in foreclosures are in the Toronto area. It's just not the case here in Vancouver. In fact, month over month, foreclosures are down 11 less units. We're sitting on a total of 245 foreclosures across the lower mainland, 0.017%, really, really tiny percentage. And it's barely moved since we started sharing this data with you in October of last year, right? There's 230 then, 245 now. So no spike in foreclosures. But again, I think people are listing to sell and offloading as opposed to just having to be in a troublesome position with the banks and with their credit scores, etc.
Yeah, this is a bit of the next year. We'll look at days on market. How long is it actually taking you to sell your home? This is a bit of a baffling sort of month over month statistic because we're currently sitting at 16 days up on the market to sell a property when the month before was 32. That's a 50% drop, and that's the lowest we've seen since June of 2024. I'm trying to figure out how we could have such a dramatic drop in days on market. But lo and behold, here we are. And I think 32 was one of the highest we'd seen in like the last 4 years as well. It was a long time to get up to 32 days. So Vancouver, at least in terms, if your property is priced to market, you're priced well, you should see it sell within I would say 2 to 4 weeks. I'm not going to give all that 16 days on market the total credence, but it is trending in that direction as opposed to trending up.
That's what I mean by like this googly-eyed market. You've got some stats that are horrible and trending down, then you've got days on market improving dramatically. It's like, where do you look? Been a very, very bizarro land month of real estate data for February, excuse me. Now let's end on prices, right? Prices is always interesting here. And remember last month we reported how HPI actually rose a little bit, followed by the fact that I said that median and average dropped dramatically, so that HPI was a bit of an anomaly. Well, here we are. Now it's kind of catching up, right? So HPI actually dropped about $4,000 last month for month over month and sits at $1,169,000. Year over year, we're only down 1%. So, the severe drop hasn't happened year over year, though there's going to be some base effects likely coming into play as the year moves forward. And ultimately, HPI has dropped 8 of the last 9 months, essentially falling since June of 2024. So how much has it dropped since of that recent cycle peak? 3.5%. Again, nothing too dramatic, but hey, we're clearly trending down. In case you're wondering, home prices are 26% higher than pre-pandemic prices. So I don't know if it's going to come down that far. I don't think it will, but I've been wrong before. But let's expand further. Median price, again, remember last month it dropped $60,000. Well, it actually increased a little bit, $2,000 in February, now sitting at $920K. And average fared slightly better, increasing $16,000 to $1,228,000, obviously. Next month, predictions, HPI is still catching up. HPI will drop in March is definitely my prediction. We have a hard time predicting 3 months out often, in the best case scenario. Now it's hard to almost guess 3 hours out, but Ryan, let's give it our best shot. What's going to happen for the rest of March here in our real estate world?
Well, I think the story going through the springtime is going to be the Bank of Canada. If tariffs stay the same, which I don't know, if they might get worse, some pieces are sounding like they might get negotiated on. I don't know. But at the end of the day, I think the storyline to watch here will be less to do with prices and more to do with the Bank of Canada. If rates become cheaper, the overall sort of drive to stimulate the economy, if you missed getting a really, really low rate during that COVID era, you're not going to see them get as low as they were, but this will be, the next best thing that you can get. So I would, if you're renewing or if you're trying to buy a home or you're making a move up, watch the Bank of Canada carefully right now. I think there could be some opportunity for you inside of this crisis.
I think that is sage advice. And yeah, we might see a bit of a market where the masses are running one way and there might be a couple opportunities the other way. Obviously case by case, and talk to your professional about if it's right for you. Thank you, as always, for tuning in, watching, listening. Hope you found this one valuable. Please share the episode with somebody that you think will enjoy it too. If you did, and we will see you here again next week. Bye.